So once again, good evening, everyone. Welcome to tonight's webinar. I'm your host, Nixon from CGS-CIMB. Tonight's webinar is part of a series of webinars under Learn from the Pros. And tonight, of course, we have with us Kong Hao to share with us a lot more about the current market situation. That's why the webinar is titled Seizing Opportunities Amid Times of Unrest and Inflation. As some of you may have already known, if not, allow me to just introduce the Learn from a Pro series, which is a yearly series of educational webinar that CGS-CIMB brings to retail investors. And we have different market expert with us this year. We have Ho Seng Fu, who is a reminder of CGS-CIMB with close to 30 years of experience. And he ran the 4-session online workshop in September. So for those of you who have attended the session, thank you for participating. And for those who did not, maybe you can check it out next year. Unfortunately, his session recording will not be shared due to copyright issue because he is also a trainer for external organization as well. But other recording for webinars can be found on the website. So allow me to just share the website URL with you. So this is the Learn from the Pros website address. So you can either click on the QR code on the screen here or go directly to the URL. You will find a past recording of webinars, except that of Seng Fu, loaded up onto the website. You can also register for upcoming session of Learn from a Pro series of webinar. So of course, we have also Weiren. Weiren is our in-house market analyst and a technician. So he does the charting market series. We will be doing one again coming new year. So do watch out for that. And with that, come to the next session. Learn from the Pros Market Talk Series, Seizing Opportunities Amid Times of Unrest and Inflation. So before we start, just a quick disclaimer. Do take note that tonight's session and information shared is for information only. It's for educational purpose and does not amount to any trade or investment recommendation. So if you do intend to partake in the market, do check with your licensed financial advisor, broker, or do your own due diligence. So with that out of the way, let me introduce Kong Hao. I'm sure most of you already know him very well. Kong Hao started as a forex trader in 1995. So that's a long time ago. And from there, he has experience both on the buy side as well as sell side. His expertise is in the market psychology, as well as looking in the market from macro outlook as well as a technical perspective. So with that, I'd like to pass the stage to Kong Hao to share with us a lot more about tonight's topic. So Kong Hao, please go ahead.
All right. First of all, thank you, my friends from CGS-CIMB, Nixon, Weipedia, and first time seeing you, Josephine. Thank you for having me. And definitely clients and invited guests of CGS-CIMB. So it's my last delivery for this year. Then after that, December, I think most of us are going for a time of unwinding session. So I hope that what I share is going to prepare you for not just where the center is coming, but it's going to prepare you for the next coming year, which is 2024. Now, let me just share my slide very quickly. Okay, so I hope I can see my slide right now. If not, maybe Nixon just give me a nudge.
Yes.
Right, so
Good.
Yeah, thank you so much. So I'm just going to go ahead with today's presentation. Of course, there are 3 segments here. The first segment where I'm going to discuss about inflation and about the Middle East conflicts. Of course, these two, especially in inflation, that will impact many of our livelihood, and our investment as well. So I'm going to discuss about that. And then, of course, the investment strategy into 2024. And I'm also going to discuss if the center is coming on the 24th of December or 25th of December this year. And as usual, with CGS-CIMB, there's always a lot of questions. So maybe along the timeline where I deliver, you can start to put in your questions in the chat box or Q&A. And Nixon is always a good host. So I just, without further ado, just get started. And this one, I will not just talk too much about it. Then just move on to the next slide here. And what presented here is not a recommendation, so please consult a licensed broker who is CGS-CIMB. And it's always a privilege to have a platform like this to share what I know about the market, to give you the insight. And my objective with many people is here tonight is that to create a lateral thinking skill. Lateral thinking skill means that we think out of the box. So I'm going to present to you what I see. It's a bit unusual. Maybe you can take home something after this 1 hour of exchanging between myself and yourself, of course, using the Q&A. And definitely what we're going to discuss here, I hope that you'll see some opportunity, but also mention about what's the coming risk. And of course, with risk, we always still can participate, but we need to measure risk with a calculated risk. It can be calculated, all this risk factor. So now very quickly, I just want to move on. And tonight, I think I just want to focus more on Q&A. And I'm just going to give you an update what's happening to the inflation. And before I start this, while having my dinner, that's maybe about 1 hour ago, I received a text that the EU have their latest inflation number. It was all good news that the latest inflation is 4 to 2.4%. At its peak, it was higher than US. US peak was last year, June. It was at 9%. EU was above 9. It was 10 plus or 11. But today it fallen so much that it's at 2.4. So it's all good news, but yet I'm still going to discuss about is inflation, is it still a concern, and what we should be looking out for, and what I believe that Jerome Powell is also looking at that number as well. Now, so what happened here is that we could see that this is a US inflation, that the inflation hit a high last year in June 2022 at 9%. It has fallen gradually, and the latest number was at 3.2. So it's all welcome. And Jerome Powell wanted to let the inflation come down to about 2% in a sustained manner. So what he wanted, and most central bank wanted to see, is that inflation is back to the good old days over the last 40 years. In fact, I know it started from 2010, but over the last 40 years, we could see that this is 2% mark, that most of the time, the inflation stay at below 2% mark. So averagely about 2%. So what he wanted to see, and most of central bank wanted to see, is that it continued to fall to about 2%. The best is at below 2%, and it stay around there. So that's what he wanted to see. But is there a risk? Yes, there's still a risk. So what I'm presented here is the last 40 to 50 years of inflation number called the US CPI year on year. And what I'm trying to present here is that the last 40 years, starting from 1982 to pre-COVID, we could literally see that this is 2%. It was hovering around 2%. So that was good over the last 40 years. But of course, during COVID, after COVID, post-COVID, the inflation reached up to 9%, and today we're at 3.2. So what worries most of the central bank is that they hope not the incident that happened in the 70s and 80s. We have exactly a very similar experience. Of course, then I was just born. I do not understand. But therefore, when we look at a data point like this, we will kind of understand what they went through back then. So the thing is that inflation reached a high of 12%, as we could see here in the 70s. It fall. And what happened is that then the central banker have also hiked the interest rate, but as the inflation fall, they make a wrong decision where they cut the interest rate too soon. So the moment they cut the interest rate, as you could see here, inflation make a V-shaped recovery and went all the way up, breaking 12%, the all-time high at a point in time, and reaching nearing 15%. So that was then, and this time round, which is more than 40 years later, the central bank around the world, especially in the United States, they are very careful because Jerome Powell, he himself said that he has studied his predecessor, that he do not want to make the same mistake again, because he said that all this interest rate hike that he have done so far, there's a lag effect. He just want it a bit more time to develop and get more sense. Is the inflation really coming down to 2% in a sustained manner? So this is what he worried. And the latest FOMC meeting where he decided to pause the interest rate hike for the second time, that was on the 1st November. He said this, that a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably towards our goal. The process of getting inflation down to 2% has a long way to go. So I know why I highlight this specifically is because during the last FOMC meeting, a day later, a week later, even up to now, there are a lot of analysts start to say that next year they're going to cut interest rate. So this is generally what investors hope. I also hope that they will cut interest rate, but I think hoping as an investor and the actual is a different thing. So what I want to do is that because the main decision maker ultimately is the central bank, United States Central Bank, which is Jerome Powell. So every FOMC meeting, it will be followed by 1 hour of FOMC conference. So the coming conference, which is very important because in between after 1st November to the next meeting, which is on the 12th and 13th of December, the CPI dropped further, which is good. So it's very important to hear what he said back then than what most of the analysts say, because most of the analysts paint me a picture that the central bank is going to cut interest rate. But from what I heard on 1st November throughout the whole year, and he is very consistent with his statement, Jerome Powell. So his statement is way more important. So you need to read into what he said. He said especially that the process of getting inflation down to 2% has a long way to go on 1st of November. So therefore, on the 13th of December, we got to get an update from him. What is he saying? That's important. Yeah, because back then in 1st November, he said that he is not thinking about cutting interest rate at all. To pause, yes, but not at all. So I hope that on the 13th December, he will still will change the tone. Then I will know exactly how to plan for my investment in 2024. But if it's going to remain the same tone, because for the last 2 years, he has maintained this tone that this statement has been seems to be cut and paste for all the meetings. So it's very standard. He's not a very candid man. That means he don't speak from his mind. He speaks from his script, and it's very structured. So his lips are always zipped very tightly. No matter how the reporter question him, he know what he want to speak, and he'll speak accordingly. So you have to listen to what he said, than more than what analysts say. Okay, now, so next slide, I want to share with you why I suspect that he's so tight with his lips that he do not say that, yes, maybe there's a possibility that we may cut the interest rate. He did not mention that at all. I suspect that maybe he's also looking at the yield curve. So towards the end, I will maybe expound a little bit on the yield curve, the implication. So basically, in short, is that what is an inverted yield curve? Because the yield curve has been inverted for the longest time since the 70s and 80s. So that means after the last inverted yield curve, it was in the 70s and 80s. And over the last 40 years, generally, the yield curve has been quite normal or healthy yield curve. When I say healthy yield curve, it means that the short-term borrowing rates, the interest rate is the lowest, the long-term borrowing rates is the highest. It makes a lot of sense. Let me just give you a perspective here. I know that there's a lot of investor here, CGS-CIMB, so definitely investing in property is not alien to you. You know what is it all about. And do you realize that the recent months, especially for this year, the yield curve, even in Singapore, has been inverted? What do I mean by that? If you have loans in your property, you'll realize that the float rate, you're borrowing for your repayment of a property, the float rate now is higher than the 2 years. So it was reversed. In the past, it was the 2 years lending rate is higher than the float rate, but now things have changed. So what I'm trying to say here is that there's an observation I made here is that in US is the same. Of course, it started from there, that the Fed fund rate, which is technically a float rate, is highest, and the 2 years is second highest, then followed by the rest. But in the past, it was the float rate is the lowest, and followed by 2 years, 5 years, 10 years, 30 years. But now it has been somewhat inverted. But what concerned me is that it has just inverted for at least a year by now. And in fact, the tendency of the inversion started in about March 2022. So that's about coming to 2 years. Yeah, but the true inversion, it was beginning of this year. So now, if you're going to Google this, after that, you'll be very curious that what is the sign of a inverted yield curve? And I think you'll be surprised to find difficulties to understand that what is the sign of an inverted yield curve. Most of them will say that it's an impending recession to come. Most of them say that, but it didn't really give me a true understanding when the short-term loan rate is higher than the long-term loan rate. What does it mean? So I'll reserve this towards the end. I'll explain to you, but let me just go through the rest of the slides so that as I explain, it will not bore you, because this will be a bit dry topic. But as things unfold, I hope that this dry topic will become more meaningful to you towards the end. Okay, so as of now, we understood that the yield curve has been inverted for the longest time. Over the last 40 years, there's a momentarily inversion, but it's a very short-lived. It come back to its normal yield curve. But over the coming to a year, or about coming 2 years by now, the yield curve has been inverted for the longest time. So that's quite a concern, where it also means that there's an impending recession to come. But later I explain to you a little bit more. Let me just get back to the screen again. Okay, I think we're good. So now let's go to what about the Middle East?
Listen here.
Yeah.
Okay. You got to switch screen. You're showing the presenter mode.
Okay, sure. Okay, I hope it's better right now.
That is good.
Okay, so now, so what about the Middle East conflicts here today is the risk of Middle East conflict to spread. Am I doing this correctly? Let me see. Yeah. Okay, so of course, this is something that as an investor, we have no control over it, but yet I think we all can prepare for it. And of course, we all hope that the Middle East conflict will, just like the last few conflicts over the last 10 or 20 years, there's a few conflicts from time to time that you will just kind of die off. There's a resolution to it. But again, that's something that we cannot control. But the concern about the Middle East conflict, whether you're a politician or you're an investor especially, is that more countries get involved in the Middle East alone. So what is the side effect of if it ever expands? So once again, we have no control, but we just have to stay tuned to it very closely. If it ever expands, what we should be getting ready for it, which is more inflation to come. Why is it so? Because in the whole of Middle East is the supply chain from the Middle East risk I'm talking about. So if more countries involved within the Middle East of this war, it will add inflation pressure to the existing uncertainty to inflation, though the inflation has been coming off. Now, let me just give you some understanding here is that the whole Middle East itself, the number one produced within the Middle East is crude oil. So if that happened, now we don't see that crude oil is coming up, but in fact it's coming down since the war started. But if more countries involved, then the crude oil is a concern. So crude oil is still necessary for everything to run at this point in time. So crude oil will get more expensive. Number two, the number two export of the Middle East to all over the world is the petrochemical, which include plastic, fertilizer, and chemical. Number three will be natural gas. So all these will be impacted. Now, the key question is, again, we have no control over all this, but if it happened, we just have to take a very close look at the development of things. So if it ever expand, then we also know that inflation pressure may start to creep up again. So if that ever happened, then inflation creep out, then what will happen to the central bank around the world? They will start to hike the interest rate. So it's a very sensitive period right now where the good news is that inflation have come down, eased from 9% to current 3.2 for US. But on the geopolitical stand, it's very sensitive because if it expand, then things will be of a different, the dynamics will be different. So I think the central banks, even as an investor, we got to watch it very closely. So I'm not exactly off guard at the moment, but I have something to share about, which is inflation finally is easing off. Okay, so that part is all about the Middle East war, where I cover about the inflation. I also cover about the Middle East conflict. Now, let me just move on to the strategy that we should be looking at. And this is what I have been doing over the last 2 years. Now, on the third week of 2022, and my strategy in the US market, in Asia, and commodities have changed. And it became much more acute of how I plan my trade. And it has changed. And since then, I've not changed my plan. And next year, moving forward to 2024, my strategy for the US market, for Asia market, and the commodity market remain the same. Now, let me explain to you what happened. For the US market, first is that, let me just take on the technical reason first. Then after that, I'll give you the fundamental reason. So this is what I call the quantamental analysis. Quantamental analysis means that first we understand what's happening to the fundamental, because we believe that the fundamental is the leading indicator. Ultimately, it will shift the market. The market will follow what the fundamental says. And how I do it is that first we have to understand fundamental. What is the fundamental telling us? If the fundamental is telling us that it's going to shift down or move up, I will wait upon the technical reason to give me that timing. Yeah, so I combine both the fundamental, the macro development, or the fundamental with the technical study. Now let's get to the technical part. First is that why on the third week of 2022, for the US market, I've changed my strategy from being a passive investor, means that to buy and hold a stock over the long term. On the third week of 2022, I became a trader in the US market, which is very true. Now I'm going to share with you why. Now, technically is that you could see that almost a straight line up for 2022 to 2021. Then I saw that on the third week of last year, third week of 2022, it broke below this downtrend line. And why? I was watching it like a hawk back then in the beginning of 2022, waiting for it to break, because the fundamental itself, let me just give you a recap here, is that in April 2021, the inflation in the United States has emerged from 2% to suddenly jump to 4%. And that's what I saw. That was April 2021. From 4%, it jumped to 5 to 6. But that means what I'm seeing that before April 2021, inflation generally was healthy at 2%. And then April onwards in 2021, the inflation started to jump to 4%, to 5, to 6. Then I know that something is wrong, but you look at the whole market, and the US market is still going up. So I was waiting that timing for it to break a very simple uptrend line drawn, and it broke, then it changes everything. Now, let me just share with you the next slide here is that we could see that this is a NASDAQ slide that we could see all the way to the year 2000. That was my plan back then. If you can get hold of the other indices like S&P and Dow Jones, you will get a very similar reading. In fact, it's even better because you will get more data. NASDAQ only started before 2000. But what I'm trying to say here is that for the longest time, many years, many decades, that the US market is a passive investment style means that if you like a stock, you buy and hold it, and you can hold it forever because it's almost like perpetually going up. But what you can see here on the third week of December, the dynamic have shifted from a long-term, almost linear to exponential up. It have shifted on the third week of 2022 to a whole year. This is a whole year of downtrend in 2022. The whole year literally was down. And this year in 2023, it was literally at the beginning of 2023, in January, it was literally uptrend. So in a way, the third week of 2022, I said I've changed my plan from investing a long-term for US market. I've changed the plan to be a trader. I just want to trade them. So basically for the whole year of 2022, I sell into strength. And the whole year of 2023, I recognize it's moving up and I buy into dips. But what is the whole year of 2024? Which I felt that because of the inverted yield curve, so I'm still a little bit suspicious of what is coming ahead. So I suspect that the federal chairmen are also starting to manage data, including the yield curve, because yield curve, it is important. The yield curve has inverted. And for that reason, I'm a bit suspicious about, although the CPI has been coming down, but I'm very careful. I'm very on guard because the yield curve has inverted. So towards the end, I'll explain to you why I felt. I'll give my reason why yield curve is inverted and what is the trouble that is ahead. Now, let's look at on the third week of 2022, and we could literally see that with this uptrend line. Now I'm going back to the technical. So earlier, I give you the fundamental reason why the shift into 2022, I've changed my strategy in the US market as a passive investor to trade the US market. We could literally see 2022, it was down, and the whole year of 2023, it was up. And technically, if you draw a uptrend line, you could see that it break below. And technically, if you draw a downtrend line, you can see that it break above. Okay, so tonight, I'm not going to discuss too deep about the US stock market because I want to bring the attention back to the commodity market and also the Asia market, which is Singapore market. Now, so I'm expecting that because of the yield curve is inverted, and if the yield curve has revert back to a healthy yield curve, I think that's all good news, which I believe that the rally should continue into 2024. But if the yield curve continue to be inverted into next year, that will be the second year of inverted yield curve, then I will likely suspect that I'm just waiting for this break to come. You could see that I'm drawing this very nice uptrend line, waiting for this break to come, coupled with the fundamental news as it may develop over time. So this is my expectation that we could see literally on the third week of 2022 onwards, market is moving down, moving up, maybe in 2024. I suspect that it may be coming off, provided the yield curve is still inverted. Okay, now let me just move into the commodities market, and then we have more time for Q&A, but I will cover more time on the Asian market here. Now, the commodity market, since the third week of 2022, my mandate is to just buy them, because what I saw in the beginning of April 2021, the CPI started to rise. So even today, although it comes down to 3.2, but I'm still a bit cautious that accident might happen. That's what I think the central bank are hoping not to see, that unexpected news may happen. Now, so commodity to me is quite clear-cut, is to just buy them. Now, let me explain to you why is it so. Technically, I believe that gold is one of the best indicator for inflation. And where is gold today? Gold today is at $2,060. So this chart, it was prepared a week ago, or I would say 2 weeks ago, because I need to prepare this whole deck to give it to the compliance of CGS-CIMB for their clearance. So then I prepared this slide. It was $1,900 and maybe $70, and today the gold is at $2,060. But over this time frame, even at the third week of 2022, you could see that gold is from there till now, gold is still moving up. In fact, the whole cycle since 2008 until today, gold is still moving up. So the inflation, so gold is a good indication of inflation. If today gold is at $2,060, so what does it speak to you about inflation? So to me, I felt that inflation is not exactly over yet, but yet the CPI is telling us at 3.2. So I'm watching it very closely. And Jerome Powell, his statement doesn't give any hint that he's going to cut interest rate on the 1st November. So on the 13th December this year, after the coming FOMC meeting, and followed by a conference, if you have time, please spend that 1 hour. I think it'll be a very productive 1 hour that even better than this webinar. So you will have a sense of what his thoughts are at a point in time. Yeah. So now, what is gold happening right now is that very technical. Of course, there's a fundamental reason is because of, in fact, gold is also a currency today. It's no longer just commodities. What kind of currency is gold market? In fact, gold is US dollars. So we did a study about gold as a currency, gold versus US dollars. So currency is always a pair. If I talk about dollar Sing, today dollar Sing is coming off. When I say dollar Sing coming off, it means that US dollars have weakened and Sing dollars has strengthened. So when we look at gold, we just have to look at gold as a currency pair, gold versus US dollars. If gold is moving up, it also means that US dollars is coming down. Yeah. So if US dollars is coming down, literally, if you look at the dollar index, of course, what I presented here, maybe not in the slides here, but what you could do is that you can Google about dollar index. You could see that dollar are coming down quite fast and quite strong. And again, if you look at the US dollars, if it's coming down, it also means that it's not a good news for inflation, because when currency US dollars is down, it also means that there is a leading indicator. The lag effect will come, the inflation will subsequently pick up. When the currency weaken, inflation should pick up subsequently. But what we're looking at here for the gold is that I saw this formation called cup and handle formation that you could see very clearly. If I'm going to draw a straight line, and this slide deck was presented to the compliance team 2 weeks ago. As we could see here, the gold was still at 1950 or 60, 70 level. But today is at 2060, around here. So if I believe that if you're going to close strong for this month, I suspect that the next few weeks to come, the commodity market will continue to charge up. So in fact, the whole series of commodities market, gold is a leading indicator compared to the other commodities which are observed over the years, that as long as gold continue to move up, the rest may subsequently follow. So there's this lagging effect that I'm talking about. Now, so of course, then how to participate in gold is that, of course, you can buy the physical gold, but physical gold, you have to pay the spread. Sometimes the spread can be quite expensive if you're not getting the 1 kilo bar kind of gold. So the spread is definitely much wider than the ETF or the spot market. So one way you can participate in gold is to buy into the gold ETF, which I prepared this SGX website here, including the QR code. It's quite a friendly platform, I would say, that you can study into different market, from REITs to stocks to structured warrant and different kind of instrument. And we saw this goal. In fact, what I do for the goal is that over the past many years, that whenever I have a surplus cash flow, so I try to enjoy my life a little bit, have income. I also try to save, and also there's some surplus. I hope that you have some surplus. If not, you don't have surplus, try to create some surplus if you can. So as long as there's some surplus, I will always remember about, can I buy some more gold ETF in SGX, or maybe some physical gold bar or gold-related stocks? You can find a few in SGX as well. So this is what I've been doing for gold as a long-term investor, because I do believe that the inflation over the long run will be still on the rise. That's what I'm seeing here. Now, let me just discuss about the Asian market right now. So what happened to the Asian market is that since the third week of 2022, my mandate was for US markets to trade them. For commodity is to buy them. So it's quite straightforward, as you could see, the commodities. And for the Asian market, I did mention since then until today and until next year, I'll still do the same thing, is to accumulate them. Now, notice that when I say accumulate them, it means that I do not have an idea where the Asian market is moving. Why do I accumulate them? Is because I'm seeing much more value today compared to the US market. Now, the US market is that I trade them is because of the rising inflation, I suspect that you will get more volatile, which what we saw earlier, that 2022 was a whole year of down year, and 2023, this year, was a whole year of up year. But I will continue to accumulate the Asia stocks because now you may ask me, Konhao, if what you're seeing is 2024, because of the inverted yield curve, the US market is coming down, does it mean that the Asia market will also come down as well? I would say that the answer is yes. Why? Because US market is still the number one economy, number one market in the whole world. So if US market is succumb to pressure because of inflation, which it may pick up later again because of the inverted yield curve that we're seeing today, so Asia market will be also resisted as well. But what I'm trying to say here is that if that happened, Asia market in terms of the down move will be quite limited compared to the US market. That's why the US market, if you notice over the past years, they also have a lot of mention about the concern of hard landing. So that is always my concern for the US market. But Asia market, if that happened, I do not think that we were going to have a hard landing. Now, the reason why is very simple, that over the years, we could see the US market have move in force, literally move in force. If you're going to compare, especially in 2008 and onwards, it moved in force. But for Asia market, are we moving in force? We are kind of stagnated for the longest time over the last 20 years. And let me just refer to the China market. In fact, the last 20 years, if you can recall, that when we flip, our clothes are all made in China. But today, when you look at our t-shirt, are now all made in China. The last 20 years, when we look at our appliances, are made in Japan. When we look at our car, are made in Japan. But today, 20 years later, most of the handphone electronics today, at least I'm holding one China-made phone, Oppo, which I kind of like it. And when I invest in China or Asia, I need to buy the product and test it. So my current Oppo phone have lasted me for 4 years. It's amazing. So I don't change it. So it's very lasting. And we also have more China car on the road, BYD. Yeah, so you could see that the change that the China company are getting more high-tech into not just in Singapore, but all over the world. But yet, if you look at the stock market, it's still stagnated at the price of which about 20 years ago. Slightly higher, but it's still the same. So there's this divergence here that I'm seeing here, that therefore I'm seeing that Asia, there's a lot of value here. It's not just China, but Singapore as well. If you look at us 20 years ago and 20 years later, we have changed tremendously, but yet our stock market is not performing that well. So what's happening right here is that I think the first time that I did a presentation with CGS-CIMB, that was about 2 years ago. And this was what I presented. Back then, I shared about my observation in almost every market and every stocks. There are cycle, and every cycle, there are 4 stages. And this cycle may repeat if the stock there's a longevity in it. But sometimes they make mistake. So now every cycle, there are stage of income or an R&D stage or a range state. Yeah, so come far enough, if they have a breakthrough, this was what breakthrough for Top Glove. If this breakthrough or new initiative is able to sustain, it may enter into a growth stage. But however, if the growth stage is not being carefully managed, it may also enter into a decline stage. So we discussed about this 2 years back. And let me just do a recap here. Why Singapore? So earlier I mentioned about what happened to Asia is that you look at China, you look at Singapore, over the last 20 years, we are kind of still stagnated at this point. So what is happening here, where I'm seeing that the world is still very uncertain because of the inflation pressure. And I think this year in the national rally, the Prime Minister did mention that we have to expect to live in a inflation pressure that this inflation may continue to stay that way. So this is what he said, which I kind of acknowledge it. So in a world of very uncertainty where inflation take a toll to a lot of uncertainty in market, which I'm still very on guard on what's happening. But Asia market, Singapore, you look at the last 20 years, is still behaving that. But I believe that the Asian market are getting the value, especially during this COVID period. In fact, we have emerged, many Asian countries, the ASEAN country and China have emerged stronger through Asia in various sectors, especially for Singapore in tech, financial, pharmaceutical, trade, air, green. So I suspect that we are done with this income stage. In time to come, we may move into a value proposition. So it may take some years, but this is what I'm seeing here. So therefore, in the world outside of Asia, so much uncertainty, I will continue to accumulate good, valuable blue chip stocks in Singapore and in Asia. So that's my strategy. So where is the best place to park money right now? A bit more on the safer environment. Personally, I believe is in Asia. So for those that are tuning to my talk before, I think I'm pretty consistent. In the third week of 2022, I have this mandate. Today, it is still the same. But the US market have been trading them, so that's a different story. Now let's look at another example on the physical stock, which I'm going to cover about Yang Zhijiang in a short while. And of course, for Singapore stock, how you want to accumulate them if you find that as an individual, it's difficult to narrow down to individual stocks. But if you find that what I just mentioned make a lot of sense, that Asia or Singapore, there's a lot of value. What we have gone through the last 20 years, there's so much transformation, but our stock is not moving double the digit, not moving in full. So what's happening? But for that reason, I'm saying it's an opportunity for me to accumulate. So if you find that stock picking is difficult to do, I understand that, then maybe you can consider STI ETF, where they also pay dividends. So this is something that I love to accumulate as well, the STI ETF as well. So I included the QR code. You can go and scan and look for STI ETF and study more about it. Now let's look at another example that with that mandate of Asia market to accumulate. How did I do that? Now, this is a sharing that I shared on the 20th September 2022, about a year ago, but also will showcase what is the end result today. Now, let's look at what happened to Yang Zhijiang back then, about slightly more than a year ago. So we literally, structurally, we saw that there's a period of range, income stage. So at the point in time where I shared on 20th September 2022, I saw that the market started to break away from the range. So in terms of the behavior size of the price movement, it is speaking to me something, that there must be a reason why the price move away from its range. So I start to investigate what's the fundamental reasons, so and so forth. But very much depend on China. That's at the point in time, that was my analysis. So we could see that that's the value stage, which is a breakthrough is coming. But if the initiative can sustain through, it may get into a growth stage. Now let's look at 1 year on. Where is Yang Zhijiang today? Now Yang Zhijiang today is at it reached a high of about coming close to about 180. Today's at 146. But if you look at the point where we identified the value stage at the point in time is about $1, about 80 cents at the point in time, about $1 to be specific. When it go up to about 180, it was about 80% gain. Today is about still more than 40% gain. So it's not too bad. And I would say that there's a potential for it to continue to grow. So this is how I identified that structurally, we can look at, when I say that Asia market, I'm keen to accumulate, that's what I mean. There's still a lot of Asia market in Singapore and elsewhere. Look out for those good, valuable stocks that no one take notice of. But once it start to break above this range, that find a value proposition, what they are doing now and what is the potential. So especially at this value stage, if it can arise, that it break away from the range, go and find out, study about the company. What are they doing? What is the potential? Is there a reason for them to get into the growth stage? So this is technically, I think it excites me a lot. And especially when it can confirm with some fundamental development, to me is a go ahead. But of course, again, when I mention the word accumulate, it means that you don't buy, even no matter how confident you are, or even if you work for the company. Yeah, you could see the flow of the business is good, but you do not dump every saving to that company. So you accumulate in tranches. If you want to invest in $10,000, if that's all you have, maybe you start with 2,000 first. So you gradually invest in it, get your finger wet, learn more about the company, then you'll gradually in tune with what the company is doing. Okay, let me just share with you, how about this week sharing? So I share all these every week. Now, this week sharing is iFast. Now, compared to Top Glove, which I believe that for it to enter into the next cycle, it may be a bit tough. So to me, my opinion, Top Glove, it may be in a cold storage, but we saw earlier the example that a stock been through one cycle, and this cycle, there are 4 stages. But this will be a bit more on the positive notes, that I believe that iFast may have an opportunity to enter to the next cycle, which is you'll go through the income stage, value stage, growth, and perhaps decline stage if they're not careful with their growth management. So what we saw in iFast was that we discussed about this before. We saw the value stage, then it started to grow. But come to a point, we also saw this double top as well. I think it was not with CGS-CIMB. I discussed that with during one of the talk with SGX. We also discovered that we saw that this a co-completion of the whole cycle. So this week, our case study was that I believe that the whole iFast is moving into the next cycle. So I just want to let you know that if you ask me a question that does every stock move into, if it move into the decline stage of one cycle, does it mean that you'll move into another cycle? I would say that it depends on the industry, depends on the company. Some company were never able to get back to the next cycle because whatever the product they are selling is outdated, it is no longer usable. There are many reasons, but I believe that iFast, what I was saying here is that it may have the opportunity to enter into a next cycle. Now, let's move on to the last topic here before I take on the Q&A. That let's discuss about the year-end rally. Is it on the horizon? Is the center coming at the end of the year? Now, so if you're going to ask me today, because today is 30th November 2023. So if you ask me, are we expecting a year-end rally on the horizon? Then I would say that if you ask me this question, likely you are a trader. And I think the answer, if you are going to be a trader, the answer is likely a yes. Maybe I think there's a little bit more upside to go. Look at the inflation number has been coming down. But the 12th and 13th December, the meeting is important, FOMC meeting. Highly likely, Jerome Powell will continue the pause rate for the 3rd time. But what is more important is to hear what he said. Now, he said is more important. If he still continue to sing the same note as we're still going to continue to focus on the bring down inflation to 2%, and it's still a long way to go. If he say that, I think likely market may enter into a correction. Yeah. So, but if you're going to ask me, how about 2020-24? My answer is that this rally may be short-term to limit up to about 2023. But 2024 will be another story. Why? Because, again, that the yield curve is inverted. Now, let me just bring you to this topic here, which is the last topic before I get into the Q&A, is that why yield curve is important. Okay, I'm going to spend maybe about 5 minutes on this. That what we could see here is that the yield curve, over the last 40 years, generally, we could see that these are something like float rate. These are 2 years tenure, 5 years tenure, 10 years, 30 years, borrowing rates. Yeah. So on the float rate, the lending rate is always the lowest in a healthy yield curve. So expected 2 years, you pay a bit more. 5 years, you pay, if you get a loan, if you're going to get a loan for 30 years, you pay the most. But something have happened over the last 2 years. You could see that since about 2022, in fact, the yield curve start to invert. And that is the first time that in that relation is that, let me just bring you a bit closer to home. The context is that what is an inverted yield curve is this, is that do you realize that your housing loan, if you're on the private loan here, is that the housing loan for the first time this year, that the float rate is higher than the 2 years tenure. So this is what I mean by inversion of the yield curve. But in the past 40 years, it was a healthy yield curve. The float rate is always the lowest. 2 years tenure is higher than the float rate. But of course, in Singapore context, the housing loan is only float rate and 2 years. Yeah. So generally, but in US, there are all these 2 years, 5 years, 10 years, and 30 years. Now, what we could see here is that the yield curve has inverted. And earlier I did mention that if you're going to find out, and you can ask the ChatGPT and say that what is the implication and what's the reason, what's the implication when a yield curve is inverted? They will just tell you, and most of the economists will tell you that when the yield curve is inverted, it also means it's a pending recession to come. Of course, the next question I want to know is why? Why, when a short-term rate is higher than the further end, the borrowing rates, there's going to be recession? I want to know why. Okay, let me just give you the my understanding here is this. Now, so what we're seeing here is 30 years yield. What's all these? These are the US government's borrowings. So they create all these treasury bonds, and we, yourself, are the investors. Now, so yield are for investors and lending. So we look at all this yield. That means the US Treasury issue all these 30 years Treasury, 10 years Treasury. So if that means they borrow from us, say, for example, if we invest in the Treasury. So in the past was that the longer time frame, the 30 years bonds, they're going to pay high interest rate. But today, the 2 years, which is the shortest one, is paying the highest interest compared to the 30 years. So what's happening right now? I'm going to ask you this question, exactly what is happening. Why is the US government offer me a higher interest rate payout? If I'm going to loan to them, they're going to pay me more interest for the 2 years Treasury compared to the 30 years. So what can your answer be? A borrower who is a US government issued Treasury is going to give me a higher interest rate for the 2 years bonds. Why is it so? Now, my understanding here is that I try to understand the logic behind is that if someone asks you for a loan and they're going to pay you more interest on the short term, 2 years, what does it mean? It means that these are something like a bridging loan. It means that they need liquid cash. Yeah, because they want to entice you to invest in them. 2 years, offer much higher interest rate. But 30 years is too far, is a lower interest rate. So it means to me that there's some liquidity issue. Maybe, I do not know, but in that context, I'm still a bit concerned. As long as the yield curve is inverted, I would say that in 2024, I would still like to be very on guard of what's happening to US. So I'll maintain my stand of what I started in the third week of 2022. For US market, I'm just going to trade them. Trade them means that I'll get in fast and get out fast. But I'm seeing a lot of value in the Singapore market, Asia market. I will continue to invest in them, to accumulate them. And for commodities market, as what we could see that gold is already picking up again from last week. So I'll continue to buy into dips into commodities. And I can say that a lot of commodities market are still around the low. So perhaps it's a good opportunity to look at the gold market. And again, how can you get involved in the commodities market? Then you can approach your broker, who is CGS-CIMB. So with that, I think just want to conclude, always keep in mind that have both fundamental, because fundamental will give us the clear direction what's heading or moving ahead. It may not be now, but I will use technical to timing. Yeah. So with the inverted yield curve, as long as it stay inverted, I'll be a bit cautious. Why is the US government or the Treasury need to pay so much interest, which is higher than their 30 years loan rate? Are they in some kind of crisis? Do they need a lot of liquidity? So that's my question. So I'm very cautious about this. And before I go into Q&A, so I just want to give you some of the, if you want to get connected with me, a few ways. That's my Facebook page, and I have a TradingView account as well. The name is the same. My name, Kon Hao, joined together. So on my next webinar or seminar or talks that I have, usually I'll post it up on my Facebook page so you can continue to follow me. YouTube, I will encourage you to subscribe to it. The channel name is Invest and Trade with Insight. For those that you want to learn about how to draw the uptrend line and downtrend line correctly, I think I produced quite a number of YouTube video there. Of course, every week I will try to upload a video based on the latest insights of the market. So I'll always enjoy that. And for this weekly sharing that I have, you can find more information on this website on weipedia.com. So last of all, it's always nice to receive some email from you. For every session, if you find that what I share, it kind of intrigue you to discover further, do write me a note. I'll be happy to receive that. Of course, with that little testimony, I will share with CGS-CIMB as well. So I'm going to turn this time to Nixon. We're going to have a time of Q&A, and just feel free to ask any question. I will do my best to answer whatever question that you may have.
All right. Thanks, Kong Hao, for your very insightful sharing as usual. Before we proceed with the Q&A question, so just allow me to share my screen here. Hold on a while. All right, so I think all of you can see the screen showing title, give us your feedback. So like Kong Hao mentioned, we really treasure your feedback, and the feedback actually helps us in many, many ways. One of them is, of course, it gives us, and Kong Hao also, the encouragement to keep doing this and bring all these wonderful insight to you for free. And then the other part, of course, is also to justify internally to our company to continue doing this, to set aside a budget for doing this session, hopefully to continue next year as well. So we really appreciate your help in giving us your feedback. You can use your phone to take the QR code to do the feedback forms, or you can just use a URL that I'm sharing in the chat box for that. So with that done, we can then go straight into the Q&A segment. So if there's any question from the floor, please feel free to just key into the Q&A box, and we will definitely come to them one by one. Okay, so just allow me to just check. Okay, I see Ada says that I should be speaking nearer to my mic. Can all of you hear me well? Maybe I need to move nearer. Okay, is this better? I think Kong Hao, maybe. Do I sound better now? Okay, great. So let's look at some of the question and answer. Okay, Ada says slightly better. Okay. My mic is pretty near actually, so maybe it's the volume as well, but let me speak louder and closer as well. All right, so let me look at the Q&A box. All right, we have a couple of questions here. Just let me go through and pick some of them here. Okay, hold on. Okay, there's a question from Teck Chun, okay, or Teck Chun, okay. Pardon me if I pronounce the name wrongly. He's saying, hi, Kong Hao. According to your presentation, since inflation is in the horizon, should we be holding our horses now instead of accumulating? Thank you.
What do you mean by holding your horses?
I think what it means is not doing anything. Just keep your cash.
Okay, I think this part I think is a very good question here. And for those who want to keep cash, yeah, I enjoy keeping cash as well. But I have a strategy how to keep cash. Of course, since about 2 years ago, me and my family, we started this how to keep some cash is that we do a 3 months fixed D roll. Because since that the yield curve, the short-term yield curve is going to move faster and higher than the long-term. So it also means that the 3 months fixed D were each month or each quarter, it may be higher. Yeah, so it makes sense that don't lock your fixed D to too long-term. I keep it 3 years fixed auto roll. So in case I've forgotten about it. So you can keep the fixed D. I do that, especially during this season. The last 2 years, I will continue to do that. But of course, then you say that, Kon Hao, you're not really a true blue investor, because how can you keep your money in the fixed deposit or saving? Yes, it really depends on the time and season. Over the last 40 years, I think if I'm going to say that is wrong, we should keep our money always invested. But this time and season, if the interest rate is going to be higher, this period, this season, I do not know this season how long will last, but what we could see that the inverted yield curve is still there, and it means that the short-term returns, yield market, lending market is higher, then I'll just keep my 3 months roll, keep on rolling, but not perpetually. What I do there is that if I have no idea to invest at this point in time, I'll keep the 3 months, keep on rolling every quarter. But whenever I've identified interesting stocks, stocks that I find that is in the value stage, about to go into the growth stage with good proposition on this fundamental, I may want to mature my 3 months, some portion of it, and load that into a specific stocks. So yes, I'll be holding my horses, but in the same time, like what I say, that I will accumulate into Asia. So earlier I shared some example on Yang Zijiang, I shared an example on iFast, and I would say that there's a lot of Asia stocks of such quality. Do look out for it if you can. Yep.
Okay, thanks. That's a wonderful idea, the 3 month fixed D roll.
Yeah.
Yeah, I think just to follow on that, I also be curious to know, because you say that you do keep some cash and you are also accumulating Asia stocks, right? So the thing is, we do not know the time horizon. How long is this period of accumulation before market move up? And so how do we apportion that, the ratio of cash to investment? I mean, just thinking, for myself, if I were to do it, I was like, okay, how much of it should I actually use for accumulation, and how much of it should I actually keep as reserve? Because I have no idea the timing.
Yeah, so next, I think it's a very good question. I have no answer to that, but because it really depends on, as an individual, your life cycle, which part of your life you're in. And I would say that personally, my kids are generally quite grown up. Yeah, they are not working yet, but they don't need much of my time. They are mostly teenager right now. And I don't have much liabilities. It means that I don't have to pay the assets that I'm in. I do not have to pay monthly interest, because basically I see what's coming ahead. About 2-3 years ago, 3 years back, 4 years back, I started to clear whatever I could. And I still remember then I have a little argument with my wife, because my wife don't see eye to eye. But I know what's coming ahead in 2021, 22. And that means I try to pay down whatever liabilities that I have. So it's proven that because only time will tell, which I do the right strategy. So again, it really depends on who you are. I'm 51 this year. Unknowingly, I thought I'm still 50, but my friend reminded me that I'm 51 this year. So if you're 51 years old and you don't have much liabilities, but you're quite savvy, then I think that you should keep your this ratio as fluid as possible. Time to up to 70%, 80% investment, you do it. Yeah. So I have no answer to that, because it really depends on at what life cycle you're in, or even you're 50 years old, 51 years old means that I'm classified as a young senior. Yeah. Yeah. So starting this year, yeah, so I'm a young senior already. So though I'm young senior, but I'm still quite aggressive. When time to get aggressive, I will get aggressive. So, but this time not yet. But when the whole Asian market, especially Singapore market, now in the accumulation phase. So of course, every month, every quarter, there's new cash flow coming in of my own business, own trading fund, all this and that. Things are different. I will continue to accumulate, especially those stocks that pay dividends. You can consider STI ETF. It pays dividends as well. Sometimes I may get aggressive along the timeline, so I have no absolute answer for you, but I think you know what I'm trying to say here. So you have to do a profile identification of yourself. Yeah. So, but try not to take on too much loan if possible, because I do not think that the hike in interest rate is going to settle anytime soon. It may cut. Yeah. So the next question I saw, I think from Louis, that do you think that the Fed will cut interest rate? Now, the thing is that the central bank may cut one or twice. Yeah. But once they cut one or twice, it still depends on subsequent data, because Jerome Powell also mentioned that very specifically, it really depends on the totality of the coming data. Meeting by meeting, time by time. He said that. Yeah. So what he's trying to say here is, honestly, I do not know. It really depends on the next CPI number, the next few set of data, or maybe even an inverted yield curve. He didn't mention about inverted yield curve. That's from me, but I suspect that he's also looking at the inverted yield curve as well. So he also don't know, really. So he need to take one step at a time, because things will change. Although from 9%, it come down to 3.2%, and today EU is 2.4%. It's good, all good news. I think I'm happy about it. But again, we just have to be very careful what's coming ahead, because there's always the unexpected. So once we prepare for that, when the unexpected come, it will not be a surprise. Yeah. So I still want to stay very cautious on what's coming ahead in 2024.
Okay, great. I'm looking at a question from Louis that he mentioned. So basically, the question was, will central bank cut rates immediately when inflations fall below 2%? Or actually, will central bank actually look at how long inflation stays below 2% before they take action to cut? So what do you think? Do you think they will cut immediately, or do you think that they will actually wait a while for it to stabilize before they take action?
Then you just follow what Jerome Powell said. He said that in all the FOMC meeting for 2 years by now, the last 2 years, he is very consistent. We want to see inflation down to 2% in a sustained way, but as of now, it's still a long way to go. That's why he say consistently, including the statement that he made on 1st November. So read into what he said. Yeah, so analysts will say a different thing, because sometimes the analysts may work for the banks, investment banks. Of course, they will have their own agenda. So you have to listen to what the man say is more important. Then do make a date on the 13th of December, what he's going to say. In case you're like me, we're in overseas trip. But what I do is that in overseas trip, the family vacation, year-end vacation, where this is a favorite pastime of most Singaporean, is that I will still find a time in the YouTube. What you can do is to just Google FOMC conference. A few days later, you can view that 1 hour of interview between himself and the reporters. Yeah. So if you can't get hold of the video, you can go and Google it. You just type FOMC conference transcript. The transcript will be loaded on some platform the next day. Yeah. So you can read about it while you're taking a plane or taking a wrong train ride to one place to another. So yeah, read into what the man say. Yeah.
Right. Yeah. Thanks, Hong Hao. All right. The question from Jack Cheria. Sorry if I didn't pronounce it right. But Jack is saying, instead of an outright recession, what are the chances for a very long duration of stagflation to occur? And if it does, what should we do?
Yeah, I think that's a very good question here, because according to what most scholars says, they only mention this, but they didn't give the reason why. That whenever there's an inverted yield curve, it also means that there's an impending recession, which I agree. I can spend a bit of time to explain that, why recession may come. Must well just do that. Why recession may come? Because that the export number has fallen. Yeah, export number of US all over the world has fallen. Literally fallen since the peak of COVID. So every month, every quarter has been keep on falling. So the GDP number, part of the equation is export number, but the GDP equation, part of the equation is also called investment, government spending, and consumer spending as well. But all these, what I'm going to project here, all this spending, government spending, consumer spending, and investment may also drop. Why is it so? Because let me just give you some fact here that since June 2022, last year, since June 2022, Fed has been doing this reducing its balance sheet. Reducing its balance sheet, it means that they no longer buy the treasury. That was June 2022. Did I say Fed? No, it's June 2022. That was last year until here today that Fed so far has reduced by $1 trillion US. So if Fed do not buy the treasury, it means that there's no surplus of cash circulating in the market. Yeah, so that means it may have a reduce in government spending, investment, and consumer spending in time to come, because all this, there's some lagging effect. Can you see that the equation of GDP is equal to consumer spending, investment, and government spending with export and import? Yeah, so export is down. Naturally, the GDP will come down. With 2 quarters of down GDP, then the meeting of the agency will come together to decide whether there's a recession. So looking at the lesser government spending and the lower export number, it seems to me recession should come with the indicator of inverted yield curve. So it's even more certain. That's what I'm trying to say here. Then the other question that you have is that, will there be stagflation? That really concerns me. Stagflation, it means that recession plus inflation, which is, then some of you may ask me, how is it possible with recession there's still inflation? Yes, that's the point here, is that there's I think the recession threat is more real. Inflation, I hope, will come down, but based on the last few reading that we have in CPI, inflation is coming down. But I just presented you the other chart earlier, which is gold. Gold has been just pushed up to 2060 US dollars today. It gap up. So that was what I see. I presented it to the Summit to Compliance in CGS-CIMB, that gold was there at about 1970, but today is literally 100 US dollars higher. So gold also represents the inflation. So when we look at gold, that is still keep on moving up, it also represents that inflation may still in the back. So I cannot say that whether stagflation will come, but I would say that the recession is more of a real threat because the government spending have dropped and the export number is coming down. So recession, I think, is part of my equation. Inflation, I just have to continue to check on what's happening around. So I do not hope that will happen, because if stagflation comes, everything is bad. Yeah, but it's good to know. I hope you'll not come, but at least if it come, the 1.5 hour session that we have, we are equipped and we're prepared for it. Yeah, so you may adopt my strategy. US market, don't hold too long-term perspective. Don't be too passive. I would prefer to be passive in the Asia market. So at least the downside risk is, I hope that's limited, but I'll continue to get hold of commodity stocks, ETF funds. Do check with your brokers. Yeah, CGS-CIMB, how to get involved in all this.
Okay, thanks. Thanks, Kong Hao. Sorry, I got the feedback from Ada that my sound is a bit soft. So just let me check first. Testing 1, 2, 3. Yeah, okay. I can hear it, my own voice. Okay. Sorry, just doing a technical check. So there's a couple of questions. Since you mentioned about commodities, Kong Hao, besides gold, what other commodities should we look at, and how do we invest in those?
A lot of commodities. You can look at oil. I think oil is OPEC Plus having this meeting. I think after that, the oil, I suspect, will go up. So oil over the last, after the conflict started in Middle East, oil has been coming down. But to me, all this coming down, short-term down, is the best opportunity to pick up some oil-related stocks. What to buy? I think I'm not in the best position to tell you specifically what to buy. Therefore, the licensed broker is there. I do not have a license to advise. CGS-CIMB, you can check with them. of course, again, if you do not know what to buy, what I do for my own family fund is that I'm referring to my children's account as well. So I manage my children's account. Is that what you could do is that you can buy into those commodities ETF as well. It's available in SGX. So what you can do is that check with broker. Yeah. So importantly, some of the ETF, they do pay dividends as well. So you can check with them. Who are they?
Okay, talking about oil, there's Medan mentioned in the chat box. What about palm oil?
Okay, I'm not a palm oil expert, but generally when I say the commodities, I'm referring to mostly all the edible commodities. And I will give you this insight here is that, do you feel that okay, maybe I'll ask you this question. Do you think that the food prices that we are all consuming today is going to get more expensive over the next 2, 3 to 5 years? If your answer is yes, of course, you do not understand why. But I would suspect that most of you will say that the food prices, palm oil is the food prices, over the next 2, 3 years and 5 years is going to be more. I do not know how much more, definitely more than what today we are paying. Yeah. So today I just make a trip to a food court, newly renovated food court in one of the hospital in Singapore, because I sent my daughter for a little minor surgery. And to my shock is that the food court prices is no longer, I can't find anything about maybe 550. The food court prices now is about, some is $10 and above. So definitely, I think the food prices is still continue to rise. So for that reason, I would say that most of the edible commodities, it's time to take a look at. If it's not going up now, over this year is coming down. That's, to me, is good news, because just imagine that the bull has started in commodities in 2021-22, and 2023 to me is a retracement. Yeah, a bull retracement. To me, we should seriously take a look at commodities to buy into dips, because if you believe that the food prices the next 2, 3 years and 5 years is going to get more expensive, then what is the hesitant about? Yeah, so continue to accumulate in those commodity stocks if what I say tonight makes sense to you.
All right, thanks, Kong Hao. Okay, moving back to the Q&A box, question from Stephen Koh. He's asking, what's the view on Singapore REIT market in 2024?
Yeah, so I just did a Chinese webinar in China on Singapore REITs, partnership with SGX as well. So with that, I think I got some intake about SGX REITs. So maybe one question that I throw to you, Stephen, here is that just now you may have saw my presentation on the structure way of we're looking at the whole cycle. There's income, value, growth, and decline. And can I ask you a question? Of course, you don't have to answer. I'll give you an answer anyway. But let me just ask you a question for the listener to think about it. For REITs, whether is it in Singapore REITs or elsewhere, Australia, all REITs, what stage of this life cycle is REITs at? Is it income, value, growth, or decline? It's only income. Yeah, it's only income. Income stage, you could see that the other way, what I term REITs as income stage is also a range. So when REITs, I think about 2 years ago, it was at a high, everybody asked me whether I can buy REITs. Honestly, my answer is no. Because in the range market, if it's at a high, you should sell the REITs. But now most of the REITs in Singapore are around the low. Then to me, it's a time to pick up, because basically on the income stage for REITs, because the whole objective for REITs is not capital gain. It will never get into a growth market. Yeah, so if it's at a high, it's because that is at the top side of a range. It may get a bit technical, but for those who understand, I think you'll get it. So REITs is an income stage, means that it's always in a range. If it's at a high, you just have to take it as that REITs at the point in time is at the top of the range. So I will prefer to let go of it because it's a bit overvalued at the point in time. So, but now I think a lot of good REITs in Singapore are at the lower of this range. It's time to accumulate REITs. If your focus is not on capital gain, your focus is to earn dividend. Because if you got buy at the top side of the range, you may receive capital gain, but you also suffer the capital loss subsequently. So it doesn't make sense to me. But if you're going to buy the bottom of the range for REITs, so there's a tendency it may bounce back up to the range high, then you have both capital gain and dividend. So this is a strategy that we should look into REITs. Yeah. So whatever that's hot in the REITs means that it's already at a high. Avoid chasing after it. Yeah. So I hope I didn't get too technical about that, but I suspect that half of you will understand what I'm talking about.
Okay, great. Thanks, Kong Hao. Madam also commented in chat box that you are good lah, Kong Hao. Okay.
Yeah, thank you so much.
Thank you, Kong. Appreciate if you can also put it into feedback form so that we can actually have it a record for our management so that we can keep the session coming. Let me look at the Q&A box now. Bert is asking, will tourism continue in 2024? What do you think, Kong Hao?
Will tourism continue in 2024? It really depends on what's coming up. If recession hits, do you think it will come? Do you think recession will come? Based on what I just mentioned, that the government spending in US is lesser, and that's part of the GDP equation, and export number has been coming down, I think recession should come. But I think the Asia part, we are a bit more blessed. I think I'm talking about ASEAN, China, including China. I think we're managing it very well. So maybe we're not looking at the huge market that the European tourists will come here, because I think the recession may hit them based on what I just described on inverted yield curve, on spending, and export number. So all these are pointing towards recession will come in the West. But I think on the East, I think tourism will still continue. I would say that it's quite a defensive market, because if we're not going to get tourists from the West, so at least I think within ASEAN and China, they're still going to come to Singapore and visit. I wouldn't see it as going to be an exuberant growth tourism stock in 2024 if recession hit in US. But I think it's still, if you're going to look at tourism as a dividend stocks, yes, I would think that you're still going to continue to get some dividends. So if you're going to position as an income stocks like the range, do get into tourism if you're interested in tourism, to buy on the low range. And when it goes to the high, since it's not going to get into any growth because of a pending recession in the West, then be realistic to cash out some money if you reach the top side of the range as well. Yeah, so that's what I'm seeing here. And just a note about China market. In fact, personally, I welcome what they've done over the last 3 years. If you still remember, of course, China, it seems looks bad, but to me, I suspect I know what the government are trying to do in the China market. In fact, they're having a short-term pain, but I suspect it's going to be a long-term good. Let me just give you a recap what happened to China. Of course, now it don't seem like a good story because the property is down, but I think it's a self-inflicted necessary measure they have taken in 2021. If you still remember in 2021, China suddenly, they clamped down their property market. Suddenly, they clamped down a lot of industry. Suddenly, really suddenly. Okay, so then, of course, I was scratching my head what's happening, but earlier I also shared that in April 2021, I start to see that inflation number in US start to move up from 2% in very comfortable range to 4% for the first time in April 2021. But that was also the same period where China started to clamp down on all this leverage property development. So at a point in time where they come in so fierce, and of course, I know it's going to affect the property market. But can you imagine if they don't do it then in 2021 to clamp down all this heavy leverage property market between the developer and the consumer, which are their retailer? So today, I think most of them will suffer with inflation, right? With high interest rate. But I would say that maybe it seems to me that they know what's coming ahead. In 2022, of course, the world is having inflation, high interest rate. Can you imagine if you are into heavy leverage in property when interest rates so high? How will the homeowner who's on loan, how would they suffer? Bad. Yeah. But the clampdown, it was necessary. That's what I felt. And therefore, I think that what China is trying to do is trying to deleverage over the last few years on what is coming ahead. We're still living in a time of very uncertain time because of high inflation. The risk is still there. And with high inflation, interest rate. And again, I'm going to go back to the inverted yield curve. And that's what we're seeing here.
All right. Thanks, Kong Hao. We are probably coming towards the end. So if there's any last question you guys want to ask, do pop in the Q&A box. So I just wait for a while to see if there's any more questions. And also while waiting, maybe just do a quick reminder about the feedback form. So I'm showing the screen again. If you can, please help us to fill in the feedback form. We really appreciate it. I think it keeps Kong Hao going and keeps him coming back to share with us a lot more. And of course, also keep us going to bring this series of webinar to you this year as well as next year. So let me take a look at the Q&A box again. I don't see any questions, so I guess we are okay and done for tonight, Kong Hao.
Thank you so much. Thank you so much, everyone.
All right. Thanks, Kong Hao, for your very insightful sharing as usual. And thank you, everyone, for your participation. I wish you all a good week ahead, and we'll see each other soon. Thank you and goodbye.